You've got a panel of people with a lot of experience and knowledge of Africa to help us go through the opportunities on this continent for our industry, for the hotel industry. And maybe I can just ask people, are there anybody in the room who's not in Africa already, or are you already investing, operating in Africa? Anybody put up their hands who's not there yet, who's looking at this continent for the first time? Okay, well, that's great. So there's a few. Trevor?
Yeah. Raise two hands then.
Yeah. So, and then it means a lot of you have already got some experience. Maybe it's the beginnings of your experience and it's proving tough. Maybe you're already successful. If so, we'd like to hear from you as well today. What I've done is I've got literally a handful of slides to talk about Africa and just set the scene, if you like, or the context. First of all, we all hear about GDP growth. So this is the last few years, sub-Saharan Africa GDP growth. As you can see, growth percentage now 5.5%, 6% in the last couple of years. And obviously now grown from just under 500 billion US to 610 billion US. So that's the one story you always hear, fantastic GDP growth. And it is, it's great. But maybe just remember, base is low, the base is low. But we are seeing good sustained growth in most of the countries. If we actually look at the actual GDP amount, Nigeria is head and shoulders above the rest of sub-Saharan Africa, but I didn't plot South Africa. So South Africa is just what will take us off the graph. In terms of it's still the dominant one, although the growth rate that South Africa is achieving compared to the growth rate Nigeria is achieving, Nigeria is touted to overtake South Africa as the subcontinent's biggest GDP country. But then you see the others are small after Nigeria. So really, GDP, economic activity, not that great yet in sub-Saharan Africa. Another measure to look at, because the next thing you hear, growing, burgeoning middle class. So what is the per capita GDP in Africa? Here, actually, Angola sticks out as the most richest country in sub-Saharan Africa, followed by Ghana and Nigeria, sort of roughly equally, Kenya and Ethiopia, and the rest sort of go off the bottom of the chart. But if you were to look at South Africa, look at Angola is 2.6. South Africa is $11,600 US per annum, GDP per capita. So it's 4 times the nearest equivalent. And then if you look at the China, the EU, the USA, so yes, we've got a growing middle class, yes, we've got a growing continent, but compared to where you guys are also putting your hotels, it's a different picture, quite a different picture. Always interesting to us in the industry is where is business coming from, and business often follows trade, and so do your investors for that matter. So I always think it's good to look at our trading partners in Africa because they fill the hotels, and China, head and shoulders above the rest now, is the biggest trading partner of Africa, followed by the States, India. So India up there, so you're seeing a brick pattern to some extent, and South Africa here. Brazil doesn't really make it, but it's beginning to become more important as a trading partner. So what you don't see is the European countries, very interestingly, as top trading partners overall. So but China is head and shoulders up there, followed by the States in terms of the trade patterns with this continent or subcontinent. Where does the UNWTO think tourism on the continent is going to grow? This little brown line at the bottom is Africa. Okay, so we were at the bottom, or we actually weren't. Sorry, the Middle East was below us, and the Middle East overtook us about here in 2005, and we come out here just below the Middle East, then Americas, then Asia Pacific, and then Europe in terms of where arrivals will go. So in terms of receiving international arrivals and inter-regional, so if somebody from Ethiopia goes to Kenya, they're in these numbers. So you've got your inter-regional here, and you've got your continental arrivals into the continent. We're actually last. And we move from all of 5% of global arrivals to 7% of global arrivals. So again, I love Africa, and I think there is a lot of opportunity, but let's get it in context, and so you understand where this continent really is and what's really out there. So our share of arrivals gets to 128 billion by 2030 is the prediction. Quick snapshot, courtesy of STR, and I think Thomas is in the room, so thank you, Thomas, of some of the aspects of, we have Middle East and Africa globulated together here, with very minimal growth in terms of occupancy in 2013 over 2012. So no great shakes, but the only growth really was in Europe, which saw a bit more of a rebound in terms of occupancy, and we were between Asia Pacific and Americas in terms of growth. So not unlike the rest of the world there. But what we did see in South Africa, and maybe Thomas can help me as to what the definition of South Africa is, whether it's sub-Saharan or whether it's actually SADC, very much South Africa, but it's sub-Saharan, okay, thanks. So it's sub-Saharan Africa. Unfortunately, there we saw, commensurate with very minimal growth in occupancy, a declining average room rate. So it wasn't the best year on the continent for trading. that really is a quick snapshot, very, very briefly on the hotel industry. And then I'm going to hand over to my panel, who first I'll introduce and ask them to say a little bit about their business on the continent and what they do on the continent. But we thought we'd just show you a map as well. Just because some people are geographically challenged about Africa. First of all, it's massive. And if you know somebody in Kenya, and I live in Joburg, I'm not likely to know them. They're not my neighbor. And I'm sure some of you might have seen that people take Europe, the entire Europe, China, and a whole bunch of other countries, and they fit it all into Africa. The landmass of Africa is phenomenally huge, and sub-Saharan Africa is about 47 countries. And you can't always count because they keep splitting up and getting back together again.
Yeah. New ones.
Yeah. And also,
IHIF2014.
you have 51. So it depends on sub-Saharan versus Africa versus where's the Middle East start and stop, and we won't worry too much about it. But just sort of show you. I mean, obviously, from down here, South Africa, the very developed country at the bottom, through up to sort of some very Saharan countries actually at the top there. Massive continent. 47 countries, all different. But the panelists, I'm sure, will talk about that. So joining me here on the panel today, we have Alex Kyriakides, who is the Development Director, Middle East and Africa. Am I correct? President. Okay.
From Marriott.
From Marriott. That one I'll get right. From Marriott. Thank you. Andrew McLaughlin, maybe you should say who you are so I don't get it wrong.
Hi, I'm Andrew McLaughlin. I'm the Vice President for Development for Africa for the Indian Ocean Islands with the Carlson Residor Hotel Group.
Okay. Hannah?
My name is Hannah Messerly, and welcome to all of you. It's great to see you here today. As Gillian said, making it all the way down to the end of the hall for what we hope will be a great session. I work with the World Bank in Washington, D.C., and I cover Africa as well as expanding into other areas such as Russia, Haiti, Romania, and other places, but fundamentally focused on working with governments to help develop their private sector through tourism and through various types of activities, including policy, hotels, and other infrastructure development.
Dario. Dario is, instead of Doris Sorin, so Dario Filippone.
Filippone, yes, well done.
From Mangalis Hotels.
Yes, from Mangalis Management Group. I'm the development director, and we are a new player in the market, and we have developed 3 brands.
Perhaps I can just mention and give Trevor another accolade, even though he's never been in Africa. Trevor Ward of W Hotels does an Africa pipeline, and he showed a few of us yesterday morning the latest Africa pipeline statistics, which had, I think it's 215 hotels in the pipeline, Trevor. 215 hotels in your pipeline, was it? In sub-Saharan Africa, yeah, 215 hotels. 40,000 rooms. And amongst those, the 2 leading brands were Marriott and Residor, Carlson Residor. But the new player on the block was Mangalis with one of their brands. So they've actually got into the sort of top 5 on the pipeline very, very quickly. So I'm going to ask Dario first. What's Mangalis doing with a new brand, new group, and choosing Africa as the continent to concentrate on?
Well, first of all, Africa is has been a natural choice for the mother company, which is Telium, because it is an African company, and they saw the opportunity of the tourism market in Africa. Therefore, they decided to start a completely new management company. So starting from the base, the creation of the brands, the creation of the standards, the development of the product, and of course the development of the hotels. So at the moment we have 15 hotels that are under development in Africa, mainly concentrated in the Central and Western Africa. We are in Congo, DRC, Sierra Leone. We are in Liberia, Nigeria as well. And the idea is to create the first group that would put Africa in the hospitality world map.
And your parent company that's African, what was their business in Africa?
They have several brands. It's a conglomerate. So they have real estate, banks. Then they have also aviation. They have also insurance and production.
And are any of your hotels open, already operating, or they're all in a construction phase?
They're all in construction phase. The first one will come to the market this year, end of this year, and will be in Conakry, Guinea.
Okay, thanks very much.
You're welcome.
Andrew, Residor, Carlson Residor, you've been operating and opening hotels on the continent and probably leading the field for a while. So tell us why you're interested in Africa.
Well, I think We've entered Africa in the year 2000, so relative to some of our sort of global competitors, we're a late starter to Africa. Very, very focused on the African market. We've grown from 1 hotel to 53 hotels in a relatively short period of time. Had a couple of milestones along the way. Besides arriving in Africa in the year 2000, in 2007 we established a dedicated development team in Africa, really having sort of boots on the ground, and that was quite a big sort of step forward to us being able to accelerate our growth. Since opening that office, we've added another 45 hotels to the African continent. And in 2014, we had a look at where we are today, where we have 53 hotels, 23 open, 30 under development. We should open 7 this year if we don't have any bumps in the road. We've been fast growing in Africa. We now really want to sort of accelerate our growth in Africa. So we've sort of identified key markets that we want to really accelerate and grow even faster. I think if any of you were around last night, we hosted the opening reception. The theme was Africa. It was a message that we're really sort of sending out to the investment community that as an emerging market, Africa is one of the sort of most important sort of emerging markets for us. To date, we've only been growing with 2 brands, our upper upscale brand Radisson Blu, which is globally a well-recognized brand, and Park Inn by Radisson, which is a mid-scale brand. We will also bring Radisson Red, which is a brand we launched last week, to select markets in Africa, and a luxury brand called Corvus Collection, which we also believe in certain markets in Africa there's space for that brand to also enter sub-Saharan Africa.
Great, thank you. And Alex, Marriott obviously had a footprint in Africa. You've got a pipeline of new projects, but you've done a massive deal recently, or you're concluding a deal with Protea Hotels, a South African management company.
Yes.
So,
Marriott's been in Africa for 35 years. The first hotel was the Cairo Marriott, which I used to audit as a young auditor in Arthur Andersen. And today we have 45 hotels, nearly 13,000 rooms in operation, Middle East and Africa, and about the same number in the pipeline, half of which, interestingly, are in Africa and will come on stream over the next 3 years. So certainly fast growth. But we felt that this was the time to step up the commitment to Africa. When we looked at the fundamentals of this continent, and you heard some of the things from Gillian earlier today, not just the growth in the population, but ultimately with the growth in the wealth of the continent, the growth in the middle classes, the very young demographic, 80% of the population is Gen XY, and if you look at 2050, 70% of the population will be Gen Z. These are extremely attractive fundamentals. And to take Gillian's point earlier, it's not really about inbound tourism. The low-hanging fruit for us in our industry, and where we see it as Marriott International, is in the domestic and regional traveler. That's where the name of the game is at. And we felt it was a time to really step up the commitment and make a bold move in Africa. And I'm delighted that we are going to be completing the acquisition of Protea at the end of this month. And that would take us really to add another 11,000 rooms to our distribution in Africa, 115 incremental hotels, and really put us in the #1 slot in terms of distribution in Africa at just under 20,000 rooms. Strategically, this is a very important acquisition by Marriott. It's about the team. The Protea team is highly professional, truly respected team led by Arthur Gillis with 30 years of experience of doing work in Africa. It's easy for people to say, yeah, I've got hotels coming up in Africa. But what we can say now is that we have hotels in Africa, but actually we got the infrastructure, we got the people who know how to work in Africa to support our owners and our guests. The other key thing here is the brand. The brand Protea is highly respected in South Africa, Sub-Saharan Africa, and we see it as part of the Marriott family of brands as having great legs. And if we put the distribution, that's Marriott, behind that brand, we think our owners will be very, very pleased with the performance of our hotels. So we are excited. We are literally at a pivotal point in Marriott's history in Middle East and Africa. And it would actually mean also that the balance between Middle East and Africa will be balanced. Before we were heavily weighted towards Middle East. Now we can truly say Middle East and Africa. And if you look at the traffic, just look at what's happening with the airline network between the Middle East and Africa today. We think there is a great potential leverage here in the Marriott brands being so strong in the Middle East. Actually, that traffic into Africa helping us with Protea. So we're very excited, Gillian.
Okay, Alex, you've touched on a couple of things there that I wanted to pick on, so I'll come back to one of them later. One of them I'm going to go for now, and then I want to give Hannah a chance. But a lot of people have often said, and it'd be nice to get other people's comments, that the brands, international brands, should consider adjusting for the African market. And adjusting, people mean perhaps on the specifications, perhaps it's just not quite possible to get the same specs, the same requirements that the brands have when they put their footprint down globally. Are you not going to do that with Protea? Isn't that what's going to happen? You're going to have an adjusted brand with the Protea brand? Will it be modified to come and fit into one of the Marriotts, or are you going to keep it as a separate sub-brand that will have those quirks and idiosyncrasies to it?
No, Protea enjoys a great following and a great brand recognition. So we're not looking today as Marriott to frankly tinker about with the Protea brand. Rather, what we're going to do is enable that brand to achieve even greater success in the marketplace. So within 3 months of completing the transaction, every single room in the Protea portfolio will be on Marriott.com. Very shortly after that, any of the guests will be able to enjoy Marriott rewards in and out, meaning earn Marriott Reward loyalty points and deploy those Marriott Reward loyalty points in Africa or elsewhere internationally. It will have the ability to leverage off of the distribution system that is Marriott, and also bring into play the support that comes with our sales and marketing across Middle East and Africa.
But it'll be a peculiar Protea Africa brand. You're not going to put Protea hotels into the States or the Middle East. You're not going to take a Protea Marriott brand and roll it anywhere else. It'll remain a unique African brand for you.
I think it will remain unique to Middle East and Africa for the time being. But again, if I would just tell you, this was initially our thinking with AC Hotels, the Antonio Catalan portfolio in Spain. This was the original thinking, that it will be largely, Spain and maybe South America. But guess what? This year in the United States, we had enormous interest for AC to come into the United States, and it's being launched.
So you can find another fit.
For the time being, foreseeable future,
uniquely
it's
African.
Middle East and Africa.
Okay.
Alex, may I just ask a quick clarification question, Alex? In terms of this deal, Marriott is not purchasing the physical assets so much as bringing it into the distribution system. So in that regard, for the Africans in the room that are very loyal and committed to Protea, it's not as if you're going to go in and flag every property with Marriott now. It will still stay Protea and be through the Marriott distribution system.
That's absolutely right. The Protea Group is an integrated real estate and hotel management company. As a result of the acquisition, it will separate into what we call in our business PropCo and OpCo. The PropCo will be separate, but it's really the OpCo, the operating company, that will join the Marriott family. And you're absolutely right. There will be Protea hotels today, there'll be Protea hotels tomorrow, and
owned by the same Protea owners, but managed as well as marketed by yourselves.
That is correct.
Hannah, you're... can I hold this up?
Yeah.
Hannah, with colleagues at the World Bank, has written this thick report on tourism in Africa, harnessing tourism for growing livelihoods in Africa, or improved livelihoods. So I'd like to ask you, after writing that report and after investigating the tourism opportunities on the continent, where would you say the market gaps are in Africa? Where are the opportunities?
It's a great question, and I think it's one that, given the complexity of sub-Saharan Africa, I think it's important that we look at countries on a country-by-country basis, and I won't go through all 47, but Just as a background to that, the work that we do in Africa as it relates to tourism, and specifically sub-Saharan Africa, is both working with governments in terms of developing policies, improving business climate, investment climate, so that many of the barriers that hold back hotel development can be addressed. Another area that we also work in is in tourism policy, tourism strategy, working with governments to understand that tourism is a good thing, and it's more than just putting in a hotel here and there, but all of the connectivity as it relates to transport and various attractions, cultural heritage sites. So in that regard, I think it won't be a surprise to any of you that we have some very different kinds of tourism opportunities. We can look at the major high flow markets such as Nigeria, South Africa, maybe you could put Kenya in that group as well, where there are existing hotels, there's a desire to bring in new brands and a desire to grow with the quote-unquote international brands. At the same time, we have growing homegrown African hotel companies such as Protea, Azalea. We have the head of Azalea here as well from West Africa. And what we see is also those brands growing. And why that's happening in part is because of both the long-haul visitors that are tourists, the business people, as well as the development community that is coming and spending lots of times in hotels, as well as Africans traveling in Africa. And that's where we see tremendous opportunity, even in some of the smaller markets, because Africans are traveling. For a long time, they were dismissed as, oh, well, you know, they're just bag traders that are going back and forth across the border between Botswana and Namibia, or Botswana and other countries. In fact, that's not the case. There's significant business travel going on throughout the sub-Saharan African continent. So in that regard, we can look at a number of different countries. Namibia recently hosted the Global Adventure Travel Summit through support from MCC, and had some of the best operators, tour operators globally come in. They showcase Namibia, and Namibia's numbers are starting to grow even in a very short period of time after that. So what we see is different types of travelers as well as different types of opportunities. And I'll just add one other one to my list, which is Côte d'Ivoire. I was recently in Abidjan, and you know, there's a real sense of buzz and activity happening there as the country is coming back, and there's tremendous opportunity in terms of hotel development, but not just in Abidjan. It's along the coast in places like San Pedro and other areas. So here again, we see opportunities for hotel development linked to both business travel as well as tourism.
Thanks. The subtitle of our session today was also the institutional investor versus the entrepreneur. So I think let's just talk a little bit about finance. What are the options for finance on the continent? How difficult is it to sort out a finance deal? So Andrew, you've been finding finance. You had your fund that you mentioned to us, but what are the challenges looking for finance for hotels on this continent?
Well, I think, firstly, I think if we look at the owner class in Africa, and that's purely looking at our owner class in Africa, in our portfolio, we have 83% of our owners are African owners. We have 11% are European owners and 6% are Middle Eastern owners. Then if we look at the type of owner we have, approximately 80% of our owners are first-time hotel owners, so they're not experienced multiple hotel owners. And then if we look at the difference between sort of net wealth private individuals, public sort of government owned or sort of parastatal type of owners, and then sort of listed property funds. Sort of 6% of our portfolio sits in the listed property fund sort of section. About 15% is public ownership, and then the balance is sort of net wealth, sort of private individuals.
So what you might call entrepreneurs.
Yeah, so it's somebody who's on the ground, he's local, he's in his own country, he understands the opportunity, he's seeing the opportunity, and he's got access to good land, or he already owns good land, and he wants to move out of being a trader into owning hotel real estate, which is a good performing real estate class, and own a hotel. And then we've got to really take somebody who's potentially doesn't really understand how to actually put the deal together and
You've got to
really
teach them a lot as you go.
and really sort of assist them in packaging the deal. And part of that packaging of the deal is actually also looking at the funding structure. So typically we would look at a 50-50 or 60-40 debt to equity investment, and then have a look at how we can actually secure that debt funding from a senior lender, which could be a European bank, it could be a regional African bank, or a local bank. We've seen over the years, though, the access to debt has actually improved. It's actually got better to what it was in 2007, 2008, where we actually established a mezzanine debt facility because the access to debt was actually so difficult. With ourselves and the four Nordic development funds, we created a fund called AfriNord, where we actually provided mezzanine debt into hotels. We're looking at the market today. There's actually less appetite for the mezzanine debt because your local bank is able to give you a 7-8 year loan at a really sort of acceptable sort of interest rates. So access to debt it's still difficult, but it's easier than it was a couple of years ago. And you're now able to get dollar loans in countries like Nigeria, which in 2007, 2008, you were speaking of a 3-year loan at a 25% interest rate.
So what you're sort of saying we're seeing is a maturing investment environment for Africa.
I think what's also happened, and it's quite interesting, post the economic sort of crisis, the banking industry in Africa wasn't hit as hard as anywhere else. And the terms didn't really change, because in Africa it was already a 50-50 debt to equity basis or a 60-40. So you weren't suddenly having owners suddenly having to put more equity in. They always had to put quite a lot of equity in. But what did happen is you had a lot of skilled Africans that were working in the banking sectors in the US and in Europe coming back into Africa, coming back into the banking systems in Africa, and changing the way the regional banks actually operate. So you can see that the African banks are a lot more sophisticated today to what they were a couple of years ago. The big South African banks have also become a lot more aggressive to look at funding into the rest of Africa. And then you've got DFIs from South Africa, which are investing into Africa. You've got DFIs from Europe, which are investing in Africa from a debt point of view.
So for us to take our title, entrepreneur versus institutional investor, it was the entrepreneur was dominant. You had far more of those local high net worth individuals, but it's moving towards the institutions are coming and getting much more interested now for various different reasons.
Yeah, and you can definitely see that. You're starting to see pension funds which are now wanting to. So the owner class is evolving as the African hospitality industry is evolving, but also I think it's got a lot to do with there's such good news that you read about in Africa all the time, and people are talking about the GDP growths, and there are good returns to be had in Africa. So there's private equity firms, there's pension funds, which are all starting to
making it sound easy, actually.
I actually think there's still a fundamental challenge if you look at the two asset classes, the two investor classes. I think government and institutional, which is the bulk of our hotels, versus if you look at the entrepreneur, I think the entrepreneur means, generally speaking, that the funding is, for the most part, less of a challenge from a debt standpoint. But with it, though, comes the challenge of seeing the support of the project through. Entrepreneurs today are entrepreneurs by virtue of wealth in other sectors, not hospitality. And for them, hospitality is a sector which they always love passionately to be able to say, I own a hotel. But that sort of translates into, well, how do we get from signing to actually a hotel opening in stores? And that is, today, to this very day, a very significant challenge. We spend a lot of our time there.
So the money now is no longer as much of a challenge as the other challenges, which is
execution.
So tell me, and I've got to let Dario have a chance. Dario, yourself, other challenges, and has finance been a challenge, or is that also one that's been less of a challenge now?
Definitely finance is still a challenge. But on the other side, I agree with the others that construction and development is still a big issue. And this is why at Mangalis we have decided to internalize this process and offer also this service to potential investors. So we have a service that we call it plug and play, where basically we get all the project management and build the hotel and make it work. We bring the
Okay.
hotels to the light.
So you do a turnkey type of
It is a turnkey
project with the owner.
Exactly. So
Same as you
once-
do.
No, I think at the moment that's the, if you to say what is the missing puzzle piece at the moment, it's to shorten the gap from signing to opening.
Yeah.
So we're looking at a number of different solutions to that. So we're spending a lot of time and energy investigating that and aligning with strategic partners that you can have turnkey contractors. But in some markets there isn't a turnkey contractor, so you got to look at other types of technologies to try and shorten that gap. And it can even be from we play a much more active role in the selection of the professional team and making sure that you have the right team to actually implement the process. You see the senior lender has also learnt over the last 15 years in Africa. If you speak to some of the African senior lenders, they've got projects which hotels are still under development and it's into their 11th or 12th year, and those guys are burning. So those same senior lenders have become a lot more active in making sure that when the drawdown does happen, it actually goes into the project at the correct time. That you've got the correct contractor in play, you've got the correct project manager in play. So it's a learning process, and I think everybody's sort of aware of it and trying to shorten.
So I think we know that the African challenge is, and there's a number of unfinished hotels or hotels that started and stopped, that it's to get to opening. Once you're past opening, then you start to get your occupancies and your revenue. Hannah, you want to say something, and then Dario doesn't finish.
Not to put you on the spot, but a great sort of mini case is your property in Addis. In Ethiopia, okay? So how many of you have been to Addis or would like to develop a hotel in Addis? Okay, great. So for quite a few years in Addis Ababa, capital of Ethiopia, a humming economy right now, I got to tell you. They're building and growing very rapidly. And on the edge of a major square in Addis sat a concrete skeleton of two hotels, to be a Sofitel and a Novotel combined, over 5 years, half built, and it's been in the courts and a lot of challenges to getting it finished. And then while that was happening, the initial major hotel in the marketplace was a Hilton that is part owned by the government and has been the Hilton workhorse in Addis for years and years. And also the five-star property of Sheraton, which is one of their top properties, owned by a wealthy African, that the Hilton and the Sheraton were really the only two games in the town, so to speak, right? And along comes Residor with Radisson Blu, right? And it took from how long did it take you from the point of you getting access to the land to then the building and the opening of the property?
4 years.
4 years.
Which is quick in Africa.
It was quick.
That's quick enough.
And that was right. And it's how many rooms?
206.
206. And this one property has shifted the whole market in Addis, principally because, one, there's some choice, but there's also been communicated a sense of, you can get a deal done, and it also can be finished. But it took...
But it was a good case study. If we look at what we're talking about, different mechanics, the promoter is it's partly European, partly Ethiopian owned. They needed to have assistance from a debt point of view, from a senior debt point of view. So you've got DEG, who's a senior debt provider, and DEG's in the room. So you've got a German bank who's come in as a senior debt provider. Afrinaut participated in the project from a mezzanine debt point of view, and then some of our Afrinaut partners from Sweden and from Denmark also took an equity stake in the project. So it's really been a good collaboration of a lot of people to get this hotel off the ground. We're very happy with the trading of the hotel. It's a good 4-star property in Addis. Very reliable. It's for the owners. It's offering very good returns on investments. And Addis, you're right. It's a booming market. If we would like to grow more in Addis, but it's a good case study of really a lot of collaboration in putting the project together.
And thanks for bringing that one up. Dario, did you want to add anything else? I mean, what is the big challenge from pushing the button on a project, or before you even push the button to open the door? Is it land acquisition? Is it zoning? Is it importing the FF&E, or all of the above?
Yeah, all the above. All the above. One of the biggest challenge we had was with procurement. We wanted to make sure to build at the lowest cost possible, and also doing this by respecting one of our values, which is stimulating local entrepreneurship as well. As it has been a big challenge, and we tried to externalize at the beginning the service, but finally we understood that it was a key component of the development, so we internalized this service. So we developed a very strong procurement department, and we were able to reduce the cost by 15% of what we used to get using third-party third-party players.
And were you able to increase the local procurement component in that?
Yes, not in all the countries, because sometimes you don't have the infrastructure, so it is not physically possible. But for us, it's very important to support the community, and you start having more and more countries where you can find people that are ready, to provide. Quality is not always there, so it is still an issue. However, people learn and learn fast, and when they see the opportunity to make money, they are there and ready to help you and to assist you.
But I think from a government point of view, government involvement, we take Addis as an example as well. The owners were able to, certain import duties were waived. So if we had to look at a return on investment, the cost per key of the Radisson Blu in Addis is actually the lowest cost per key of a Radisson Blu in Africa. We open in Freetown on the 15th of April this year, and there again the government gave very good incentives to the owner to actually encourage him to actually do a hotel where there's a tax break for a number of years. There's a waiver on import duties. And it was enabled the owner to actually say, well, let's Freetown actually is in dire need of a quality hotel, and also when you factor that into the cost of the project becomes a very attractive investment for an owner, and he's going to now get into a market where hopefully we'll have first mover advantage for, I reckon,
so
5-7 years.
And
in certain countries where you're able to have those duties waived and have some tax holidays, it makes a huge difference to the success or the feasibility of the hotel. Nigeria, as an example, is the opposite. You've got to pay everything, and it's
sometimes
cost per key.
We've seen that for the 30% of the investment, it can be the double. So if you can cut that cost, as Andrew said, I mean, it's going to make it's going to make a huge difference.
Now you can see we've got some fantastic knowledge and experience of this continent on this panel. So I'd like to ask for the floor. If you've got any questions for anybody, you can ask them specifically or generally. Anybody want to ask questions?
Not all together.
So you.
I can make a quick comment.
Yep, there you go.
Just a couple of comments. Starting with, I'm from Nigeria, by the way. Starting with the numbers you ran off, I think there's a tendency to generalize. When you talked about room occupancy, I can tell you as a fact, the room occupancy in Nigeria has gone up in the last couple of years, significantly. I'm not quite sure if it's in excess of 15%, but it's definitely more than 10. So when you say there's been a decline of 3.5%,
it's an average across all the countries,
So
yeah.
it might be helpful, particularly for potential investors, to point out that, look, yes, certain markets are probably lower than 3.5, while others are doing better. So I just thought I'd point that out. And the point about what you might call dilution of global standards, I think that's something we need to take on board. There are practical problems dealing in Africa. I mean, they won't always be there. We're improving.
I don't like the word dilution either. Just call it adjustment or something.
Adjustment. That's
Good one.
So I think there has to be some level of flexibility by the international brands when they're coming in. Now, I think what might work is adjust it a little bit, and then maybe over a 5-year period,
you
scale it
creep back up again. Or
That's
back.
what I think is practical. There are real problems with work. Infrastructure, power, even personnel. Getting qualified staff is a huge problem. Getting them and training them.
I've heard it many times. That let's have some flexibility when we approach the African continent. Let's be willing to be a little bit, which I think is a Protea example. They're not going to suddenly make it all.
And also the fact that, you mentioned Nigeria. Nigeria is a huge target for Marriott International and Protea. Protea, as you know, is already in Nigeria with a very successful partnership with the African Capital Alliance. And that's a prime example of where, you know, Protea is in a major economy, South Africa, with major institutional investors, publicly quoted real estate investors such as HPF, the ACA in Nigeria. And now, you know, we will have the opportunity to speak with those partners about the Marriott brands. And this is another great win for us, because in both of those geographies, there is tremendous infrastructure already in place in Nigeria and in South Africa. In fact, on the support side, what we're gaining here is we're gaining with Protea, you know, 250 people at the headquarters in South Africa, very experienced in opening hotels, 115 of them, with Plan One, which is the architecture and construction arm of Protea. Very experienced in terms of refurbishing hotels, opening hotels right across Africa. We see this as a huge win for them and for our Marriott brands in terms of coming to market.
Thanks.
Juma, I think the challenge when it comes to data, that's the one, we don't have enough good data in Africa, and that's why stuff gets generalized all the time. It's the same as when we talk about Sub-Saharan Africa has a GDP growth of 6%, and we generalize too much. There's 16 economic communities in Africa, and each community behaves quite differently. And if you look at these economic communities, and you got to look at, and some of them are so small, and their borders were created by their predecessors, and the tribes cross, and they shouldn't have. In West Africa, in the ECOWAS community, there's 16 countries, 9 on the same currency. And some of those countries, they're close enough, you can drive from one to the other and you're going from country to country. But there's not enough data to be able to sort of generalize. Fortunately, STR has been able to pick up the stats, so you can give accurate stats on what Lagos is doing or what Abuja is doing. But you still generalize a bit.
But it's true, we've got a real data shortage, and we've also got international arrivals shortage data. There's a lot of data shortages. I see 2 hands, so let me take some other questions. One at the back there, the lady.
Yes, hello. Valentina is my name. I'm from DG. First of all, thank you, Andrew, for introducing that DG is in the room.
German Development Bank.
As we are a subsidiary of KfW, and KfW has the mandate to invest in the infrastructure in the Gaza region, which is, as you, well, maybe not everyone, but most of you will know, it's the national park between Angola, Botswana, Zambia, Zimbabwe, and what am I missing?
Angola.
Namibia. Yeah. So, and KfW has the mandate to invest into the infrastructure. Now, what is fully needed is, I think, to also invest into lodges in certain countries. And I take Zambia as one example. And I asked myself a little bit, Andrew, you mentioned and said very correctly that debt in these countries is easier found than it used to be, but that equity is the sort of, something that we need to find and bundle. How would one develop a concept, because you mentioned also that there are more insurance companies and other pension funds, institutions that are willing to invest. How would one find these investors and get in touch with them so that one could form a nice package that could be co-financed by an institution like a DFI that you mentioned, and make a nice package out of that? Because I think countries like Zambia really poorly need something for the tourism industry, and if incentives in the country are not there yet because conditions are not to invest into infrastructure, etc., how would one, with the help of somebody like the World Bank, set up such arrangement to make this possible?
I'm going to let Hannah, she's sort of a DFI, not quite, but she's related to the DFIs, answer this one. And Dario's got some comments as well.
Why don't you go? No, you go first. Go first.
I mean, I cannot be before
No.
At some point, I'd like to, but it's not going to happen. So please.
Okay, so let's talk about Zambia just really quickly because it is an interesting illustration. One is that in Zambia there is a real shortage of of hotels in the various areas. There has been also a tremendous dearth in terms of their supporting their tourism sector and marketing and promotion in particular. There is about a new law is about to go through that will help enable both the investment climate as well as the business enabling environment. And I'll just give you a quick anecdote on that. And the original draft of the law said that every general manager would have to be, for any hotel in the country, would have to be approved and registered with the government. And you can imagine the private sector said, hold on, that ain't going to happen. So I think that the law that will hopefully go through the policy and will go through and be approved by the cabinet will help address the overall environment to attract FDI. The other element, though, is creating the overall business environment, and there is some activity, for instance, even with IFC, where IFC can help put together deals, and I think also in terms of your organization to help bring together the players. Historically, though, there has been a bit of hesitancy, principally because of the overall business environment and some of the hesitancy as it comes from the government. Our hope in terms of the bank working with the government is to get the right pieces in place so that the investment community will feel more comfortable coming in and top up or augment loans where it's needed. And one great example is when you're in Zambia and you look across the falls and you see Zimbabwe. In many ways, there's a competition going on there. Good news is there's a Univisa that's being rolled out to enable tourists to go back and forth. But if you're looking at Livingston versus Zimbabwe, there's some real good competition going on there, which also helps to attract the investment. Go ahead.
Well, I want to just, first of all, to answer to you because I didn't have the chance in that moment. But before joining Mangalis, I used to be a consultant working in Africa. So, as Andrew said, it's almost impossible to use general data to have an actual real situation, the touch of the real situation. So I definitely push everybody that wants to get into Africa to call specialized consultants. Here in the room we have many. That can offer you, a better idea, and I agree with you that it's very difficult to get this data. Then for the question from Valentina, nice name. It sounds Italian, so
even though she's German, we think.
And maybe
working for the Germans, though.
Okay. So it's. I think that what we are missing, and I think what we should try to support is the creation of platforms. What I mean is that, like in the case of Protea, please correct me if I'm wrong, I believe that what Marriott bought, mainly, it has been a platform. They bought a platform that will serve them to boost the growth. And for a big company like Marriott, it is important to have this platform. And now is the time probably to create even more platform for allowing more big players to come to the market. So we should try to stimulate companies like Azalea Hotels, Mangalis, trying to create the platforms and allow more institutional investors to have somebody that is organized, structured, and can enjoy the opportunity. So I think that the idea in an ideal world, we should have big funds trying to support this kind of regional chains that start growing and get structured up to the point where we can start having more structured lenders, structured investors, and this will be probably the way to go.
But I think the way to do it is the platform has to have the DFIs and maybe some of the NGO type aid in it, and then leverage out of that the rest of the finance from other sources. So you sort of start with, and later on it'll flow by itself probably. Yep. But as a starting point for things like the Zambia area. And lodges are very different to hotels. You guys are in hotels, lodges is a very different animal to start looking at in terms of investment, in terms of synergies and economies of scale are few. But that doesn't mean to say there's not some great lodge groups operating on the continent, who some of them are commercial, some of them are very trophy orientated. Yeah, so.
But it's so important to bundle them.
Yes. To get that economy of scale.
That's why I'm asking that question.
Yeah.
But I think you also, with something like that, you need government continuity. And that's the biggest challenge in Africa is government continuity from one leader to when he steps down and a new one takes over. Is there continuity that there's a blueprint that's been mapped out and that you're gonna follow through? Because you can see in so many countries that the president today has his plan, and then the new president, when he stops whatever that was previously done and starts something new. And we have two-term, and in the second term things start, but they never get completed because there's no continuity and a follow-through. And as soon as you've got multiple countries all linking, I think it's even so the risk is when an investor or somebody's looking at it, he's concerned about what is the long-term continuity in that area.
We've literally got 5 minutes left, and you can see there's such a lot to talk about. It's late in the afternoon. Any one or two last burning questions from people in the audience? I think, did you have your hand up earlier? Valentina asked. Okay. Any other? Okay, Alcreen.
IHIF2014 hotels. We own and operate 2 Hilton Doubletrees in East Africa. Aside from the challenges of financing and procurement, one of the challenges we find as an operating business in the region is people and actually finding skilled people to operate businesses. So I'm just keen to understand from the panel, what are the brands doing to address the skill shortages? Yeah. We've seen there's a lack of good quality hospitality training schools, and perhaps that's something as brands we can collectively work together to address the skill shortage.
Can I just maybe comment? This is at the heart of the equation. And really that's another key reason why we felt the Protea transaction was very attractive for us. 15,000 associates will come with the Protea transaction, including 300 at headquarters. Fabulous talent. When we enter new markets, we do a lot of work up front to work on the talent consideration, typically about 2 years out. And to give you a live example, rather than talk theory, because Kathleen is here, who leads our global comms and PR for Marriott International in Washington, had a huge hand to play in this. We're looking at our hotel in Kigali in Rwanda, and very conscious that there isn't a depth and breadth of talent. And what we did there, we partnered with the Aquila Institute, the Ladies Aquila Institute in Kigali. And we handpicked with them 24 ladies who been now in our hotels in Dubai and in Doha for nearly 1 year. And when the hotel opens, we'll go to the hotel and be the trainer of the teams in each of the departments in the hotel. So you're absolutely right. The talent piece is huge, especially if you're talking about entering a brand new market. You go to a market like South Africa, you go to Egypt, there is a breadth and depth. Morocco, the same. But if you go to the Rwandas of this world, ultimately the Angolas of this world, you're going to run into the challenge, and you're going to nationalization challenges which limit the number of expats that you're going to put in the country. So innovative ways of developing the local talent is required.
Lovely example.
And if I could just add to that, 2 quick things. One is what's very interesting about Aquila is the selection of the students. And the whole model is different, and it addresses an issue that we find in markets around the world, which is there is often a cringe about going into hotels and tourism. And in this case, they have created a vehicle where communities pick their best and brightest to go to Aquila. They work in Aquila not only on hotel type skills, but also on life skills that then translate into their being able to go overseas, and then they are coming back. That's one thing. Second thing is in the World Bank, we see this as a huge constraint to growth in Africa in terms of hospitality and tourism. We have many people, for instance, working in the parks that are essentially scientists that haven't been trained to work with customers and with customer service. In Uganda, we have recently done a loan with the government where $25 million of it is focused on supporting Uganda's growth of the tourism sector prior to their signing the legislation, but it's okay. And part of that $25 million is to tear down and rebuild the country's largest hotel and tourism institute, and we'll have 3 pillars: hospitality skills, nature-based tourism skills, and a third in entrepreneurship. And it's the convergence of those 3 that I think will help to really address some of the needs going forward beyond the traditional hotel, learn how to cook, slice, and dice. But there are tremendous challenges across the continent, country by country, in terms of developing talent, and it's going to take solutions country by country, both on an institutional basis as well as on a hotel property and company program basis.
I see one hand. We show. Okay, sorry. And then we really do need to sort of wrapping. So.
Following on that, how would you like to retain this talent? Because I've been working in Kenya, and all our best employees, as soon as they the opportunity, were going abroad in Dubai or in Europe to have this kind of opportunity, and we're losing the best employees to train the others. So
Okay, let's see if we've got an answer from the panel. Retaining talent in Africa. Okay, Hannah.
I'm going to answer this and say, we need to get over it, to use a Layla
global
Rackism.
world.
Yeah, because every market we work in, we
There's
hear
mobility.
as soon as they're trained and capable, they go on. And we know of the mass exodus of Kenyans going into the Middle East and Abu Dhabi and Dubai, et cetera. The former Minister of Tourism loves to quote the numbers on that. The reality is they're going to come back when there's the right opportunities. And we see some movement going around, but train them in Kenya, have them work in the Middle East, and maybe they come back to West Africa.
And for us, it doesn't. For us, it's a great opportunity in a funny kind of way, in the sense that when the deal was announced with Protea, you can't believe the excitement among the Marriott team members in the Middle East and North Africa region, saying, "Gosh, I'd love to go and work in South Africa and elsewhere in Africa." And conversely, the number of Protea associates who said, "I'd love to go and work at the Marriotts in the Gulf and North Africa." And we don't mind that. We love that. So for us, it's welcome. It's when they leave Marriott that's the problem.
Okay. Guys, we're gonna have to sum up, but the panel, I'm sure, will stay here for more questions, but I'm going to give everybody 1 minute to give your best hint, whether it's a hint in terms of what governments in Africa need to do to get the continent right, or a hint to developers. What is the key thing you'd like to change if you could wave a magic wand?
Infrastructure.
Infrastructure. I like your short answer. Andrew? Sorry, I put you on the spot here.
No. It'd be the selection of your winning team. I always use the analogy of winning a football league. To win a football league, you need to have a good striker, a good defender, a good goalkeeper, good manager, good coach. To have a successful hotel development, you need to have the correct team. They might cost a little bit more, but it's going to actually save you money in the long run. You're going to have your hotel built on time, and it perform better. So pick the right team.
Infrastructure, your right team for opening. Hannah?
And mine is a bit of a caveat. Yes, Africa is rising. Keep in mind, as we heard this morning from The Economist, a lot of the activity is commodity-based and commodity-driven. That's both good news and not so good news. So it's really happening market by market, and be very thoughtful, even within a country, just as was said earlier, to look at those markets within a country very carefully.
Dario?
My tip would be look for local partners as well. Having a local contact is very, very important, because it may solve you many of the issues that we are discussing. So this would be
Great,
my tip.
quality local partner.
Yeah, quality local partner.
And one of the ones I would add, given those ones have been said, is get the airlift right in Africa. The access just isn't there, and the airlift just isn't there. Governmental issue. Okay. Thank you very much, everybody. Thank you to my esteemed panel. Thank you very much.